It happened again. Silver didn't fall because the planet discovered a new ocean of supply. Silver didn't fall because solar factories shut down or EV demand vanished overnight. Silver fell because the rules changed. A margin hike hit the futures market this morning, and it forced liquidation fast, ugly, and automatic. Last week, silver ran into the mid-80s. Then, right as traders came back from the weekend, the exchange increased how much cash you must post to hold certain silver contracts. If you were long with leverage, you woke up owing more collateral immediately. Pay it, or your broker sells you out at whatever price the market will give in that moment. That's what happened. Not a mystery, not a macro shift, a margin squeeze. Welcome back. In this breakdown, I'm going to show you the mechanics that caused the drop, the pattern that keeps repeating in silver, why the paper price can move violently even when the physical market stays firm, and what signals matter next. Quick favor before we move. Subscribe. Short and simple. If you want clean explanations when the next wave hits, you'll want the alerts on. Now let's strip away the noise and go straight to the trigger. A silver futures contract is a leverage tool. One contract represents thousands of ounces, but you don't pay for those ounces up front. You post margin, a fraction of the full CME margin requirements. Explained simply, value as a performance bond. It's the exchange saying, prove you can survive volatility. When the exchange raises margin, it changes your required cash overnight. That means your broker recalculates your account at the new requirement. If you don't have enough, you get a margin call. And if you can't meet it quickly, the broker does not negotiate. The broker liquidates. Period. Now, multiply that by a crowd. When thousands of leverage traders are forced to sell at once, you don't get orderly price discovery. You get a stampede. The sell button isn't being pressed by conviction. It's being pressed by necessity. That's why these drops look like cliffs. A normal pullback has buyers stepping in, sellers testing levels, price breathing. Forced liquidation doesn't breathe. It falls until the forced sellers are done. And the timing matters. It always matters. This margin increase hit during a thin year-end stretch when liquidity is often lighter. Lighter liquidity means the same amount of forced selling hits harder. It means stops get triggered more easily. It means a cascade can build faster than people can react. So, here's the first lesson. In silver, you're not only trading the metal, you're trading the rules around leverage. Most people learn that the hard way. Let's get more concrete because margin sounds like a boring footnote until it reaches into your account. There are usually two numbers that matter: initial margin and maintenance margin. Initial is what you need to open and hold. Maintenance is the minimum you must keep to avoid a call. When volatility spikes, those numbers can jump fast, and when they jump, they don't hit everyone equally. Big institutions can post collateral quickly. They have credit lines and treasury desks. They can move money in minutes. Smaller traders can't. Retail traders can't. A lot of people can't wire fresh cash instantly, especially during a holiday stretch when banks are slow and approvals take time. So, the market doesn't liquidate the wrong crowd first, it liquidates the least liquid crowd first. That's why these events feel unfair, because structurally they are. Now watch the chain reaction, price dips. That dip trips stops. Stops why forced selling hits like a cliff become market sells. Market sells push price lower. Lower price triggers more margin stress. More margin stress forces more liquidation. It's a self-feeding spiral. In futures, that spiral can represent an absurd amount of paper ounces trading in minutes. Not because that much metal moved, but because that many claims moved. And since the futures price is the benchmark, the claims can drag the screen price lower even if the physical market is unchanged. So you can get a world where the chart screams down while the real world sourcing stays tight. That's not a contradiction. That's structure. Now, structure doesn't win forever. Physical reality is the judge. If the paper price drops far enough below physical reality, two things tend to happen. Buyers with real cash step in, and arbitrage starts sniffing out the gap between paper and physical. It doesn't always snap back instantly. Delivery rules, vaulting and financing slow the process, but the discount becomes bait. And that bait attracts the people who matter most, end users and deep pocket accumulators, which leads to the question that becomes the cliffhanger after every margin flush. Did today's forced selling hand a discount to the exact buyers who need ounces, not opinions? Because if it did, today's crash can quietly become tomorrow's rebound. And that's why if you trade leverage, the only defense is slack. Don't run your account tight. Don't assume today's margin is tomorrow's margin. Assume it can jump when it hurts most. If you don't have room for that jump, you don't have a position. You have a timer. Now, the official explanation for margin hikes is risk management. Volatility rises, so margins rise. The exchange wants to reduce default risk. That explanation is real. Exchanges do have to protect themselves and their members. But here's the second lesson. Risk management and in price impact are not separate things. They are the same action with different marketing. Raise margin and you reduce buying power. You force some positions to close, you change the flow. You change the price. And silver has a habit of seeing this tool used at the most sensitive moments. Let's talk about the history, because history is the warning label nobody reads. Silver goes parabolic. Then the rules tighten. Restrictions and margin changes hit. The rally breaks. The story becomes a cautionary tale, not a scarcity story. Silver rips during the post-crisis money era. And as it approaches the highs, Margins get increased repeatedly in a short window. The market gets squeezed. The move reverses hard. And now, late 2025, silver surges again. Then margins get raised more than once in the same month, with the latest increase taking effect right as the market is thin. Is that proof of anything? No, I'm not here to accuse. I'm here to explain incentives and mechanics because incentives matter. If the market is heavily short by big institutions, a paper price versus physical market, why they can diverge sharp rally can hurt them. A margin hike that forces long liquidation can relieve pressure. It can create a window to cover. It can buy time. That doesn't require conspiracy. It requires basic human behavior. When you're under stress, you want relief. So ask yourself, when a wave of forced selling hits, who benefits first? The forced sellers lose control. The buyers with cash gain control. Now let's read today's action like a forensic report. The key clue is speed. Real fundamental shifts don't usually happen in 15-minute avalanches. Physical demand doesn't evaporate in a coffee break. Mines don't triple output before lunch, but paper can move that fast because paper is a claim. Claims can be created, traded, dumped, and flipped at the speed of algorithms. That's why the futures price can drop sharply without any meaningful change in the real world. And that's why you must separate paper price from physical condition. Here's what tends to happen during margin flushes. Paper price drops, headlines scream, social media panics, and then you look at the physical market. Coins, bars, wholesale premiums, and it often doesn't follow the same way. Sometimes premiums widen, sometimes dealers hold price, sometimes inventory tightens because buyers rush in to scoop discount metal. That divergence is not a guarantee of anything, but it is a signal. If silver truly became less valuable overnight, physical sellers would undercut each other to move product. You'd see desperation. Instead, you often see firmness. That tells you something important. This wasn't the world rejecting silver. This was leverage getting purged. Now, why does this purge matter? Because it changes who is left holding exposure. Leverage is fragile. It's powerful on the way up, but it shatters when rules tighten. When leveraged longs get flushed, the market often transfers ownership from weak hands to strong hands, cash buyers, longer-term holders, inducers, and physical accumulators. That's why a margin crash can be both terrifying and constructive. Terrifying because it's violent. Constructive because it clears the unstable positions that can be forced out again. So here's the cliffhanger. Today's drop might not be a trend change. It might be a purge before the next leg because the purge doesn't fix the underlying fundamentals. It was a rules event. Now, let's put the pattern under a microscope because silver has a unique talent. It teaches the same lesson in different decades. In the 1980 episode, price didn't simply decide to reverse. The market's rules tightened into the rally. Buying power got restricted, and the people who were most exposed to leverage got hit first. The story later became greed and speculation, but the mechanism was mechanical. Change the terms, force the exit. In 2011, you saw a historical pattern. Why this keeps repeating a similar rhythm. Silver surged, volatility spiked, and margin requirements were raised repeatedly in a short span. Each hike forced some traders out. Each forced exit added fuel to the next drop. It wasn't one sell-off. It was a sequence of squeezes. That's why the phrase "it happened again" matters, not as drama as a map. Because if you know the map, you stop being surprised. And here's where the map leads. If the physical market stays tight, the market can split. You can have a paper price that gets shoved around by leverage rules and a physical price that stays stubborn because real buyers keep bidding for real metal. When that split becomes wide enough, it forces a resolution. Either paper rises to meet physical or physical availability dries up and premiums explode. Both outcomes are uncomfortable for anyone who needs metal. And both outcomes are the opposite of what today's headline implies. That's why the drop can be deceptive. It can be the system screaming, "We need relief," while the physical world quietly says, "We still need ounces." So, don't let one margin memo rewrite the bigger story in your head. Let it rewrite your understanding of the battlefield. Because silver is not only a commodity, it's a stress test of trust. And every margin hike is the exchange, admitting one thing without saying it out loud. When this market runs too hot, leverage becomes the danger, not the metal. And fundamentals are the part no bulletin can rewrite. Silver is not just a monetary metal, it is a strategic industrial input. Solar uses it for conductivity and reliability. EVs use it in power electronics, contacts, and charging systems. Data centers and electronics use it in connectors and high-performance components. The grid upgrade cycle uses it in switching and control systems. Demand is not a meme, it's embedded in the hardware. Now look at supply. Most silver supply comes as a byproduct of other mining: copper, zinc, lead, gold. That means silver production doesn't respond quickly to price. If silver doubles, it doesn't instantly double mine supply. The pipeline is slow, permitting is slow, capex is slow, or grades decline. Politics intervene, so deficits matter. When the world consumes more than it produces, inventory gets drawn down. When inventory gets drawn down, the system becomes fragile. And in a fragile system, paper events become more violent because there's less cushion. That's the structural setup. Now add geography and policy because silver doesn't live in a vacuum. Large chunks of refining and manufacturing sit in Asia. Large chunks of industrial demand sit in Asia. When physical metal flows toward end users, it stops being available to satisfy paper promises. And if major exporting jurisdictions tighten rules or prioritize domestic industry, global availability can tighten further. That doesn't show up instantly in a futures candle. It shows up later in delivery stress, premiums, and inventory drains. Who benefits and who gets liquidated first? This is why silver can look calm in price and still be tense underneath. Now let's address the question people always ask after a day like this. Does this mean the rally was fake? No. It means the rally was leveraged. And leveraged rallies are vulnerable to margin shocks. That's not bullish or bearish by itself. It's a feature of the market structure. So the real question becomes, what happens after the leverage is shaken out? That depends on whether physical demand remains strong and whether inventories continue to tighten. And those are the signals you should watch, not the hot takes. Here are the 4 signals that matter more than today's candle. 1. Physical premiums. If the paper price drops, but premiums don't, the physical market is telling you the metal is still wanted. 2. Inventory levels at major warehouses and exchanges, not the rumors, the ounces. Are they draining, steady, or rebuilding? 3. Delivery behavior. Are more contracts standing, rolling, or demanding metal? Delivery demand is where the paper story collides with reality. 4. Global price alignment. If different regions are pricing physical higher than you, S-futures arbitrage will try to close the gap. Arbitrage is the leash on distortion. Now, let me get practical about what today teaches you about risk. If you were leveraged, you learned the most expensive lesson in commodities. You can be right on fundamentals and still get destroyed by mechanics because the market can force you out before you're proven right. If you were unleveraged or physical, you learned a different lesson. Volatility is noise unless it changes the real supply-demand picture. And that brings us to the psychological war that comes after a margin event. The banks and big players don't need you to believe silver is dead forever. They only need you to panic long enough to sell into the hole. You'll see the narrative flip instantly. Bubble popped. Speculators washed out. Top is in. They will speak with certainty because certainty sells, but certainty is usually fake. So don't anchor your brain to one day of price action, especially when you can point to a mechanical cause. Instead, anchor to the setup. Did a margin hike create more silver in the ground? No. Did a margin hike reduce solar production? No. Did a margin hike erase industrial demand? No. It changed collateral rules. That's it. So if the setup is unchanged, the real question is timing, not direction. Now, I'm going to ask you 2 questions, and I want your honest answer in the comments. Do you think these margin hikes are purely risk control? Or do they also function as a pressure valve when rallies threaten big short positions? And second, when paper drops but physical stays firm, which market do you trust more? The screen price or the real world price people actually pay? Answer those and read the replies. You'll learn how different people think. Now, what should you expect next? Expect volatility. After forced liquidation, the market often whipsaws. It bounces hard, then dips again. It tests nerves. It hunts stops. It punishes anyone who thinks one move means certainty. Expect attempts to shake confidence because confidence is the commodity being traded right now. And expect opportunity to appear where fear is concentrated. If, and only if, the physical signals stay tight. This is where patience becomes an edge because the majority of people are. The key signals to watch next: premiums, inventory, delivery. Emotional, oversized, and reactive. They sell the low because the chart feels like pain. The disciplined buyer does the opposite. The disciplined buyer watches the constraints, not the candles. Now, I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation, but I'm telling you what today actually was. It was a rules event, and rules events are where silver separates amateurs from pros. Amateurs think price equals truth. Pros know price can be pushed by structure, especially in a small market like silver. Silver is small. That's why it's explosive. In small markets, it doesn't take much forced selling to smash price. And it doesn't take much real buying to send it flying. That's the nature of the beast. So, here's the clean summary. Silver fell today because the exchange raised margin today, forcing leveraged longs to liquidate. The move looked dramatic because thin liquidity amplifies cascades. The move did not change the fundamentals of supply and demand. The move did expose the fragility of leverage in this market, and the next chapter will be written by the physical signals, premiums, inventories, delivery behavior, and global price alignment, not by the loudest headline. If you want the next breakdown, the moment something like this hits again, subscribe. These rule shifts don't come with warnings, and they rarely happen only once. And last question, tell me straight.